Welcome to this deep dive. We're jumping straight in today, looking at Privi Speciality Chemicals Limited, PSCL.
That's right. We've got a few key sources here.
Yep, the Q4 and full year FY25 earnings call transcript, their investor presentation for the same period, and also a Crisil Ratings Rationale from March 2025.
And our goal is pretty straightforward, to cut through all that detail and pull out what's really important for you about PSCL right now.
Exactly. We're looking at their business, the financials, what the future might hold, and, of course, the risks, getting you the essential insights from these materials.
Okay, so PSCL, fundamentally, they are India's top manufacturer and exporter of aroma and fragrance chemicals.
Been around a while, too, haven't they?
Oh, yeah, over 3 decades. And they've got a big global footprint supplying, loads of the big names the presentation mentions, over 15 of the world's largest fragrance and FMCG companies.
And the headline news from these documents, it seems, is their performance in FY25.
Absolutely. They hit record numbers, both quarterly and for the full year. Highest ever.
Which probably explains the credit rating news.
Precisely. Crisil upgraded them to AA stable. They mentioned sustained improvement in the credit profile, strong business risk profile.
And comfortable financials.
Right.
Crisil also called out specific strengths, didn't they? Something about backward integration.
Yes. That and a diversified product basket. Key strengths according to the rating agency.
Okay, let's unpack that business model and competitive edge a bit more. What are they actually doing?
So core operation is making and selling those aroma and fragrance chemicals. They've got a pretty wide range, over 70 products.
Grouped into categories.
Yeah, things like pine-based chemicals, citral-based, phenol, musk, and other specialities. And their money comes from selling these chemicals.
And you mentioned exports are big.
Hugely important. About 70% for the full year FY25, even slightly higher, 73% in the last quarter. So global demand is key.
Right. Okay, so let's dig into those competitive advantages the sources highlight. That backward integration seems to be front and center.
It really is. Crisil especially points to this as a core strength. It's about controlling critical raw materials. They've got serious capacity, 36,000 tons per year for CST, 9,600 for GTO.
Okay, CST and GTO. Why is having capacity for those specifically such a big deal?
Well, because they're foundational ingredients for a lot of aroma chemicals. And the sources, they note these can often be in short supply globally.
Ah, okay. So owning the production gives them an edge.
Exactly. It means, more consistent quality, better cost control, and crucially, supply security. When others might be scrambling for raw materials, PSCL has a degree of insulation. It's a real advantage.
Got it. Control and security. And their long history over 30 years, that must count for something too.
Absolutely. That translates into really established relationships, both with suppliers and, crucially, customers. The sources talk about them being a key supplier, a trusted partner.
Not just a vendor, but someone embedded in the industry.
Precisely. That kind of long-term trust is hard to replicate.
And the product range. Over 70 products.
Yeah, that diversification helps spread the risk. They're not reliant on just one or two things. The sources do mention pine-based products like dihydromercenol and amber fleur are pretty significant revenue drivers.
But having breadth across pine, citral, phenol, musk, that adds stability.
Exactly. It strengthens the overall business profile.
And they also mention innovation, sustainability.
Right. They're working on new, often higher value, premium products. And sustainability seems important too. They highlight an EcoVadis Gold rating, efforts to use more green power, reduce their carbon footprint. That aligns with what big global customers want to see.
Okay, so that's the business setup. Now let's get into the numbers for FY25 because, as you said, they look pretty striking in these documents.
They really do. Revenue growth was pretty healthy, 28% year-on-year jump in Q4 and 19% for the full year.
Hitting over 2,100 crore rupees. That lines up with what Crisil expected.
Yeah, Crisil had estimated around 2,000 crore, driven by, more capacity being used, good orders, and those new products shipping in.
But the profitability numbers. Wow, that's where it gets really dramatic, isn't it?
It really is. EBITDA, that's earnings before interest, taxes, depreciation, and amortization, was up 50% in Q4. 50%. And 35% for the full year.
And the bottom line, net profit, PT.
Even more impressive, up over 100% in Q4 compared to the previous year, and 94% growth for the full financial year.
Doubling your net profit in a year. What's driving that kind of leap? According to the sources, is it just the revenue growth?
Not just that, a big part of the story is margin expansion. Their EBITDA margins improved significantly.
Okay, so they're making more profit on each rupee of sale.
Exactly. Margins hit about 23.5% in Q4 and over 22% for the full year. That's up from around 20% the year before.
And Crisil noticed this too.
Yep. They saw margins above 21.5% in the 9 months they looked at and expect them to stay above 20% going forward, which suggests, better operational efficiency, maybe benefiting from higher volumes, or perhaps a shift towards more profitable products.
And all that flows down to earnings per share, which nearly doubled too, from around 24 rupees to almost 48 rupees per share.
Correct. A very strong earnings performance highlighted across the board in these materials.
Okay, let's shift gears slightly. The balance sheet. What is that snapshot from March 31st, 2025 tell us?
It shows they're still investing. Property, plant, and equipment is up, and so is capital work in progress.
Meaning they're building things, expanding capacity.
Seems like it. Putting money into their physical assets, which fits with the growth story.
And what about debt? How does that look alongside the investment?
Total borrowings were around 11,122 crore rupees. Crisil specifically notes that this includes some loans from Givaudan, about 232 crore, which they count as debt.
Okay, and the key ratios. Debt relative to equity or earnings.
They look pretty stable, actually. Net debt to equity was 0.95 times. That's slightly better than the previous year, just under 1x. And debt to EBITDA is around 2 times.
So what does that mean in practical terms? Is that a lot of debt?
Generally, for this kind of company, a net debt to equity below 1x is seen as quite healthy. And debt to EBITDA around 2x is usually considered manageable leverage. It means their earnings cover their debt reasonably well.
And the management seemed comfortable with this level.
Yeah, the transcript notes they're confident the debt to EBITDA ratio won't go above 3x.
Okay, and liquidity. Cash flow. Ability to pay bills.
Looks healthy based on the sources. Current assets are well above current liabilities, so the current ratio is strong. Cash on hand also increased.
Crisil's view.
Crisil sees their liquidity as strong. They expect cash generation from operations to comfortably cover upcoming debt payments. Plus, they noted the company isn't maxing out its bank borrowing lines. Utilization was around 70%, leaving headroom.
Right. One other point was working capital.
Yes, it's still a business that ties up cash and inventory and receivables working capital intensive, but there's a positive trend.
Improvement.
Yeah, the net working capital days actually improved, down from 151 days in FY24 to 136 in FY25.
So they're converting sales back into cash a bit faster.
Exactly. It's a sign of better operational efficiency in managing that cycle.
Okay, so recapping. Strong FY25 performance, managed debt, improving working capital. What about the future? What growth drivers do these sources point to?
The outlook presented seems pretty positive. They're banking on a few things. First, capacity expansion.
More building.
Actually, mostly debottlenecking existing lines first. They reckon they can add about 6,000 metric tons per annum that way.
Debottlenecking.
Well,
just optimizing what they already have.
Pretty much. Finding ways to squeeze more production out of current facilities. It's often quicker and cheaper than building brand new. They expect that to be done by the end of FY26 to meet demand.
And new products are still coming.
Yes. Plan is for 2 new premium products this financial year, building on the 3 they launched in FY25, like Floravane and Indomarane, expanding the portfolio.
And then there's that pre-IG plant, the joint venture with Givaudan. That sounds interesting.
Yeah, definitely one to watch. It's been commissioned, it's running. Management expects it to break even in about a year.
And they seem optimistic about it.
Very. Especially because there's a buyback arrangement. Givaudan will buy the output, which secures demand for that plant's production. It looks like a key strategic move.
They're also still focused on green power.
Right. Aiming to increase their share. The sources mention it helps lower costs, which is always good, but also reinforces their sustainability credentials. Important for those big global clients.
And there was something about changing the client relationship.
Yeah, moving beyond just being a supplier. They're aiming for deeper collaboration, co-creation with clients.
Like becoming more of a strategic partner.
Exactly. That could lock in business longer term and maybe drive innovation that's more closely aligned with what the market or specific customers need.
Okay, sounds like a positive outlook. But every business faces challenges. What risks did the sources highlight?
Well, you've got the standard industry risks, volatility in raw material prices, especially anything linked to crude oil.
Always a factor in chemicals.
Yeah, and given how much they export, foreign exchange fluctuations are also a risk. Sudden currency swings can impact earnings.
Makes sense. Any risks more specific to PSCL itself?
The working capital intensity, as we mentioned, even though it improved, it still requires careful management. And the new Privi plant, while promising, still needs about another year to fully ramp up and hit break even. There's always some execution risk with new facilities.
So how did Crisil factor these in when they upgraded the rating? Did they just ignore them?
No, not at all. A rating assessment explicitly considers risks. But Crisil's view, leading to that upgrade, was that these risks are largely offset by PSCL's strengths.
Like their market position, customer relationships.
Exactly. Product diversification, and importantly, that improving financial profile. Things like better interest coverage. The sources mention it was around 5 times in late 2024, up from 3.5x previously.
So the upgrade suggests Crisil believes the strengths and the positive financial trends outweigh the risks, at least as of March 2025.
That seems to be the conclusion from their rationale, yes.
Okay, one last area. Valuation. Did the earnings call or the presentation or Crisil give any indication of what PSCL shares are worth? Any price targets or multiples?
No. It's important to be clear here. The sources we reviewed, the earnings transcript, the presentation, the Crisil report, they don't provide any current trading multiples like PE or EBITDA, and they certainly don't give a fair value estimate.
Right, so no shortcuts on valuation from this material.
No, but what you do have now, from digging into these sources, are many of the key ingredients you'd need for that kind of analysis.
The performance numbers, the balance sheet health, the growth plans, the risks.
Exactly. All the fundamental pieces are laid out in these documents.
So let's try and pull it all together. What's the overall picture of PSCL that emerges from these specific sources?
I think the picture is of a leading company in its specific market, Aroma Chemicals. They've just come off a record year financially in FY25.
They seem to have strong competitive advantages, particularly that backward integration into raw materials.
Right, that stands out. Plus, those long-term customer relationships, they also have clear plans for growth debottlenecking, new products, the Privi JV.
And while there are risks, Crisil's assessment suggests they're manageable, balanced by the company's strengths and improving financial health.
Yeah, that's the narrative presented in these documents. This deep dive really gives you that concentrated view directly from the source material.
Okay, so here's a final thought for you to chew on, based only on what we've discussed from these sources. Think about that strategic shift they mentioned, moving from just supplying chemicals to deeper collaboration, highlighted by the Privi joint venture with a major customer, Givaudan. How might that kind of specific integrated partnership fundamentally change PSCL's position and growth prospects in the long run compared to just being a traditional supplier? Is it just locking in sales, or is it potentially creating a more powerful, stickier, maybe even more innovative business model for them down the road? Something to consider.